The most consequential inflation print of the year lands this morning at 8:30 Eastern, and every major commodity market is sitting at an inflection point when it hits. Gold is trading at $5,205 per ounce. Oil just posted its biggest weekly gain since 1985, and the Fed is caught between two impossible outcomes. Today is the day the data forces that contradiction into the open. Drop stagflation in the comments right now. One word. So I know you are here and paying attention. Stay until the end. I am going to show you exactly which CPI outcome is most dangerous for gold and silver right now, and why the direction that looks bullish on the surface could actually trigger the most violent unwind. Do not skip ahead. Every part builds on the next. This is financial education, not investment advice. Let us start with what the tape is telling you before the number even drops. Gold at $5,205 per ounce. Key resistance sitting at 5,261, 5,342, and 5,595. Silver at $88.74 Western spot. Shanghai physical at $96.78. That is a 9.06% premium. That is not a rounding error. That is a market telling you something about physical demand that paper prices have not yet absorbed. The context matters here. Oil is up 38% in a single week. The last time oil moved that far in 1 week was 1985. That is not a data point. That is a seismic event in the inflation input chain. Energy feeds into transportation. Transportation feeds into every goods price in the CPI basket. If the print today looks tame, it is looking at a rearview mirror. The forward inputs are already lit. The CPI reading arrives at 8:30 Eastern. The API crude oil stock change follows at 4:30 this afternoon. EA official inventory data prints Wednesday morning at 10:30, 3 data points in 48 hours. The market has to navigate all of them. Today's number sets the tone for how the next to get read. Here is the structural tension that no single headline will capture. The Fed currently holds rates at a level designed to fight the last inflation cycle. That cycle was supply chain shock plus fiscal stimulus plus pandemic distortion. This cycle, if it materializes, is war premium on energy plus physical commodity scarcity plus a geopolitical disruption to global shipping lanes. These are not the same inputs. The policy response to each is not the same either. Shipping through the Strait of Hormuz is near total halt. Traffic down 92-94%, over 200 tankers stranded. Ras Tanura refinery in Saudi Arabia has been struck. Qatar Energy declared force majeure on liquefied natural gas. Kuwait issued force majeure on crude and refined products. The Fujairah power and water complex in the way was targeted. Bahrain's desalination plant was struck. These are not abstract geopolitical headlines. These are direct inputs into inflation. Energy prices do not move in isolation. Water infrastructure disruption in the Gulf does not stay in the Gulf. The CPI basket is already absorbing shocks that the data collection window has not fully captured yet. So when the number lands this morning, the question is not just what it says. The question is what it is not yet saying. Now the gold and silver picture specifically. COMEX silver total inventory sits at 346 million ounces, but registered the silver that is actually available for delivery stands at 79.99 million ounces. That is a leverage ratio of 7.09 paper ounces for every physical ounce. 1 month ago that registered pile was larger, by 44.18 million ounces, an 11.31% drain in 30 days. The LBMA is holding 27,065 tons of silver, down 2.4% month over month, both pools moving in the same direction. At the same time, the Sprott Physical Silver Trust is trading at a 5.42% discount to net asset value. That spread is something to watch when physical demand overtakes paper market suppression. That discount compresses fast. It is not there yet, but inventory draining at this rate while the discount holds is a tension that resolves one way eventually. GLD absorbed $3,720 million in inflows. The institutional rotation into physical gold vehicles is not slowing. China's central bank extended gold buying to 16 consecutive months, added 30,000 troy ounces in February alone, bringing total holdings to 74.22 million ounces. Central banks are not hedging, they are positioning. Now the CPI scenarios. This is where most coverage gets it wrong. Scenario 1. Core CPI prints hot, above expectations. The disinflation narrative cracks. The Fed cannot cut. Stagflation framing takes hold because growth is already deteriorating and inflation is rising. Gold initially may dip on rate repricing, then finds its footing as stagflation premium builds. Silver follows with a lag. Oil reinforces the narrative. This is the scenario where the macro structure for hard assets strengthens over the medium term even if the immediate reaction is messy. Scenario 2. Core CPI prints soft. Markets celebrate. Rate cut expectations get pulled forward. Dollar firms. Gold and silver take a short-term hit as the rate cut trade gets repriced more aggressively into nominal assets. This is the scenario that looks bearish on the surface for metals. But here is what that reading would actually mean. The CPI basket is looking backward. Oil's 38% weekly surge has not finished flowing through to consumer prices yet. A soft core print today with this energy backdrop is not disinflation. It is a delay. The market would be wrong to read it as durable relief. Scenario 3. CPI prints in line. Markets read it as Goldilocks. Risk assets rally. Commodities hold steady. This is the least disruptive outcome and probably the one algorithmic positioning is least prepared for. In that scenario, watch the afternoon API crude number closely. That becomes the market mover for the session. Which scenario is most dangerous for the thesis? Scenario 2. A soft print? Because it invites complacency on a foundation that is actively eroding beneath the surface. Now the bear case, because I will always give you both sides. Core CPI strips out food and energy. That is by design. If headline runs hot but core prints clean, the Fed has political cover to stay on pause. That pause reprices rate cut expectations higher, firms the dollar, and creates a real headwind for gold and silver in the near term. Paper markets dominate the metals complex in the short run. Algorithms trigger on the CPI number in milliseconds. Before any fundamental analysis can react, stops get hunted, positions get unwound, and the tape moves hard in one direction. Being right on the macro does not protect you from being early. The data calendar this week adds further volatility layers. API this afternoon, EIA Wednesday, PPI Friday. Each print gives the algo layer another lever to pull against physical fundamentals. Respect that. It does not change the structure, but it can delay the tape. Tape reading summary. Gold at $5,205. Resistance at 5,261, then 5,342. A clean break above 5,261 on high volume, after a soft CPI, confirms institutional bid is structural. Failure at 5,261 after a hot print gives you a test of the prior support range. Watch the reaction, not just the number. Silver Western spot at $88.74. Shanghai premium at 9.06%. COMEX registered inventory draining. The confirmation signal for silver is a compression of the Sprott discount alongside another leg of registered inventory drain. Those two together would tell you the paper market is losing its grip on the physical price. What invalidates the thesis? A sustained dollar rally above the key resistance zone, combined with a multi-week rebuilding of COMEX registered inventory and a diplomatic resolution that materially reopens the Strait of Hormuz. That combination would signal a genuine deflation of war premium. It is not the base case given current positioning and infrastructure damage, but it is the scenario to monitor. What confirms it? A hot CPI print, continued COMEX drain, and a wider Shanghai premium crossing double digits. That trifecta would signal the paper to physical decoupling is accelerating. Now I promised you at the start that I would show you exactly which CPI outcome is most dangerous for gold and silver right now, and why the direction that looks bullish on the surface could actually trigger the most violent unwind. Here it is. A hot CPI print looks bearish in the first 5 minutes. Rate expectations reprice. Dollar ticks up. Gold and silver sell off on the initial read. But that reaction is the setup, not the conclusion. Because a hot print with oil at these levels and the Strait of Hormuz at 90% closure confirms the stagflation scenario. The Fed is trapped. They cannot cut into that. They cannot hike into a war-driven recession without breaking something in the financial system. Gold's role as a stagflation asset gets repriced higher over days and weeks, not minutes. A soft core print looks bullish in the first 5 minutes. Rate cut expectations pull forward. Risk on, metals catch a bid. But that is the dangerous scenario, because the market is reading a backward-looking number as a forward signal. while oil inputs that take 30 to 90 days to flow through to consumer prices are already baked. The soft print invites a position unwind that removes the safety margin right before the next leg of data confirms what the physical markets have already been pricing for 30 days. The most dangerous move for holders of gold and silver is not the hot print. It is the soft print that creates complacency. Watch for it. Do not confuse a relief rally with a reversal. The drain is real. The leverage ratio is real. The physical premium in Shanghai is real. None of that changes because one CPI basket looks clean for 1 month while 200 tankers sit stranded in the Gulf. If this gave you a clearer picture of what is happening, hit the like button. It takes 1 second and it helps this channel keep doing exactly this kind of work. If you are not subscribed yet, now is the time. This kind of breakdown happens here every single day. Invest with logic, not hype.